All right, so we talked about friends, family, and sort of your own pocketbook and angel investors. I also want you guys to look at something called crowdfunding. So look at Indiegogo, GoFundMe. Those are also great places to go if you're in that launch stage and you're really trying to understand how to get your business going. They're a fantastic place to start. Okay, so now you've got this early company, you've got a little bit of capital in it, and then you want to move to the next stage, and that's when your company's emerging, and that's when you're growing, you're getting customers, you've got your ideal customer identified, and you're really moving into that. There are a couple places to get funding for your business. Banks are great places, so find one, stick with one, nurture that relationship. You can also go to corporations who might be early big customers if you sell to enterprises. Friends and family, always, angels are really a phenomenal place to get capital. And then early stage are what's called seed investors, which are venture capitalists who actually invest very early in a revenue business. So that's the area. And then as your company moves from emerging to scale and to scale ready, that's when you're going for the venture capital. That's when you're doing your $10 million or your $5 million Series A or Series B, and you're establishing your company and you're looking for places to put funds that are predictable in terms of outcomes and results. That's where you really want to go for scale. And so venture capitalists, now these are people who they invest institutions' money. And so those guys are folks who you've probably heard of: Sequoia, Foundation Capital, Harlem Capital, one of my favorite new ones, Costa Noah Ventures, Scale Ventures. So that's where companies that tend to IPO, if you will, are getting a lot of their resources and a lot of their money. And so those rounds can be a Series Seed, which is kind of pre-revenue and you're just getting started. A Series A, which is you have a product, you understand what you're doing and you're going after a market. It's early. Series B is once you've really figured some of the early customer and go-to-market things out. You've got an engineering team, you've got a product, and then you move to Series C, which is real serious business. That is where you are focusing on the predictability of your revenue. You're raising a lot more money, and you're also working with investors who tend to be something called late stage versus early stage. And at this stage, they're actually looking for something very unique. One thing, predictability. They put in $1 into your business, they want to be able to get out $5 because they're looking very much at how does your company get to that scale place where it might IPO or it might be sold for $1 gazillion. So that Series C or D tends to be what happens before a company exits through an IPO or through a sale. And so those are very different stages: seed, Series A, Series B, Series C, and Series D. I've raised them all, and what you find is that the conversations change very much. In the seed and Series A, it's about the team and the bigness of the idea and the market concept and the prototype or the early product or MVP, minimally viable product. That's where those conversations tend to lie. At Series B, it's about churn rate, unit economics, customers, retention of your team, quality engineering, the effectiveness and efficacy of your sales organization. That's where that really goes. Series C, I gotta tell you, it's the funnest and also some of the most challenging conversations because it's about nothing but predictability. It becomes much more formulaic. And so if you're raising money from investors at that point, they're looking for something very specific: the quality of the management team, the predictability of those unit economics, and essentially the productivity of every dollar put into your business. So again, I want you to think about that in terms of where you are today, because you're probably in one of those stages. So IPO, that's that next stage. You're doing $100 million or $50 million in revenue, you're Stitch Fix, you're Uber, you're Lyft, you're one of these great companies, or you're kind of moving through that trajectory for a business that might be in a market that a lot of people don't know. But at the IPO, you're actually getting funds from the public markets. These are people like you and me are buying a portion of your company. So at that point, you really want to think about, how do I make this company understandable and almost legible to the average person? Einstein said, if you can't tell a 5-year-old a story, you probably don't understand it yourself. I screwed up that quote, but you get the point. The point is, at IPO, you're making this company something that everyone can understand, and it's almost how Buffett approaches things. It's a company or a product or a solution or service that everyone wants and everyone can use and everyone can relate to. So if you're running a $50,000 company right now, or a $500,000 company or $5 million or $50 million, and you're saying, Promise, I'm a growth warrior, but why are you talking about IPOs? Guys, your job as the leader of this company or one of the early leaders of this company is to truly understand what the long-term outcome, desire, and focus is for your company. Now, many of you are starting and your goal is to stay small. That's fine, and you're going to learn a lot from this section. But if you're thinking about something bigger than yourself, I want you to see the yellow brick road. I want you to understand what's next, because the decisions that you make today have an impact at every single stage. If you start your company and you overspend in the beginning and it takes long to hit those milestones, that's got its own impact. If you go quickly, maybe too quickly, that's got its own impact. Guys, all these things are related. There is no wrong answer, but it's important for you to see the entire view. So why would you raise money? Now, I know that a lot of you are thinking, I want to own 100% of my company. And someone once said to me, you can own a large percentage of something small, or you can own a smaller percentage of something large. You've all heard that. We've all heard about cutting pies and slicing things up. That's what we're talking about, essentially, which is part of thinking about your business is not the business that you're in, it's the business that you're becoming. And resources, strategy, vision, will, and effort are the bridge between those two places. And so if you're raising money or thinking about your company in the future, you're thinking about how those resources actually allow you to become the company of your fantasy or of your vision. Now, if you're running a profitable business, you are funding your business through profits. So that's another way to fund your company. So angel investors, venture capitalists, debt, private equity are all ways, but in a lot of your cases, it's going to be your own capital.